The most respected long-term investor in modern markets is sitting on $397 billion in cash, and that should tell us something. The most recent filing from Warren Buffett's Berkshire Hathaway shows the largest cash and short-term treasury position the company has ever assembled, eclipsing every previous high in its 60-year history. It's larger than the GDP of Norway and larger than the market cap of all but a handful of public companies on Earth. And it is sitting almost entirely in short-duration US Treasury bills, earning a yield of roughly 3.7%, generating Berkshire around $12 to $13 billion a year for doing nothing. Now, Warren Buffett has built a defensive cash position of this magnitude relative to Berkshire's size only twice before in his career. Once before the Dotcom collapse and once before the global financial crisis. Both times he was mocked as out of touch, and both times he was vindicated within 18 months. And so today we look at why this legendary capital allocator is choosing to do nothing with his largest war chest ever assembled, what his cash position is actually telling you about current valuations, and why investors everywhere should be paying attention. My name is Guy, and this is Coin Bureau Finance. Let's begin by looking at how this cash pile was actually built, because this did not happen overnight. At the end of 2023, Berkshire's combined cash and treasury position was sitting at roughly $168 billion, around 16% of total assets. By the end of 2024, that number had doubled to $334 billion. By the end of 2025, it hit $373 billion, the figure most of the financial press is still quoting. The most recent quarterly report, covering the first quarter of 2026, however, shows the position has grown again to $397 billion, or roughly 32% of total assets. This build-up of cash was funded primarily by selling down Berkshire's two largest equity positions methodically quarter after quarter. Apple, once the single most concentrated bet in the entire portfolio, has been cut by roughly 75% from its peak of 906 million shares down to just 228 million. Bank of America, Berkshire's other crown jewel, has been roughly halved from 1.03 billion shares down to 517 million. Buffett was a net seller of equities for approximately 12 consecutive quarters from late 2022 through to the end of 2025. Translation: this is the most patient capital allocator in modern history, systematically dismantling his largest equity bets and parking the proceeds in treasury bills. In his 2023 letter to shareholders, Buffett described Berkshire's approach as, quote, extreme fiscal conservatism, and the maths has only become more extreme since. So the question is not what Buffett and Berkshire Hathaway are doing, but why. And to answer that, we need to look at the only two previous occasions where Buffett positioned this defensively, because the historical pattern is doing most of the talking here. So the first episode came in 1999, the absolute peak of the dot-com mania. While the Nasdaq surged 102% that year and tech investors were minting paper fortunes overnight, Berkshire's Class A shares fell 23%, an underperformance gap of roughly 41 percentage points relative to the S&P 500. The financial press absolutely savaged Buffett for this. In December of 1999, Barron's published a cover story titled, and I quote, "What's wrong, Warren?" Buffett was being publicly written off as an aging investor who had lost his touch and missed the future of business. His response, delivered at the Sun Valley conference in front of a room full of tech billionaires, including Bill Gates, was that the ratio of total US market capitalization to GDP had reached around 200%, and that, in his words, investors at that level were, quote, playing with fire. Within months, the Nasdaq began collapsing. By 2002, it had fallen 77% from its peak. Microsoft shares would not recover for 16 years. Now, the second episode began in Buffett's 2002 shareholder letter, wherein he described derivatives as, quote, financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. From 2005 to 2007, he steadily built cash again as he warned about credit excess and the frightening web of mutual dependence between major financial institutions. The press played the same script as in 1999. He was missing the bull market, he was too cautious, he'd lost his edge. And then came September 2008, and the cash Buffett had spent years accumulating turned into the most lucrative buying spree of his career. Which brings us directly to the first signal that this current cash pile is sending, because Buffett does not hold cash because he likes it. He holds cash because he genuinely cannot find anything to buy at prices that satisfy his return requirements. And the data backing him up can't be ignored. The Buffett indicator, his own preferred valuation gauge, currently sits at 232%, the highest reading ever recorded. That is 16 percentage points above the 200% level he himself described as playing with fire in 1999. The S&P 500 sits at 7,200, roughly 1% below its all-time high. The tech sector is trading at a price-to-earnings ratio of 51 times, which is roughly double the trailing PE that the entire index reached at the Dotcom peak. Consumer cyclicals are trading at 78 times earnings, real estate at 58 times. The simple average across all 11 sectors is 40 times earnings against a long-run S&P trailing PE average of around 16 to 17. Apple, the position Buffett spent years aggressively reducing, saw its forward PE expand from the 10 to 15 times multiple he originally paid in 2016 to roughly 32 times by late 2025. He even halted Berkshire's own share buybacks for 5 consecutive quarters, describing his own company's stock as modestly overvalued. When the man refuses to buy his own shares, well, that tells you everything you need to know about his read on current valuations. At his final annual meeting as Berkshire Hathaway's CEO in May 2025, Buffett said he would deploy $100 billion immediately if he found an opportunity that made sense. The implicit message, of course, was that no such opportunity currently exists at scale. So, the cash position is not a bet against the market, but rather a statement that the market does not currently offer what a disciplined capital allocator needs to find compelling. But the more devastating implication is what comes next, because cash is not just defense in the Buffett playbook. And before we get into how that offense has historically been deployed, if you want to make sense of what actually matters in markets, business, and macro, then you should be signing up for the Coin Bureau Finance newsletter. It's absolutely free, it lands in your inbox every week, and we break down the stories that the mainstream press coverage misses entirely. So, all you have to do is click the link in the description or scan the QR code on your screen. And now, back to the deployment playbook. Because the second signal Buffett's cash position sends is that he is positioning for the same kind of dislocation he's deployed into twice before, and the historical record on how that deployment looks is genuinely instructive. In September 2008, with Lehman Brothers freshly collapsed and the global financial system in cardiac arrest, Buffett invested $5 billion in Goldman Sachs preferred stock. The terms, dictated entirely by him because nobody else had the cash to write that check, were a 10% perpetual dividend plus warrants to purchase $5 billion of common stock at $115 per share. That deal alone netted Berkshire over $3 billion in profit. A month later, he wrote the same kind of check to General Electric, $3 billion in preferred stock, also yielding 10%. Then he provided $6.5 billion in financing for the Mars acquisition of Wrigley, effectively functioning as a replacement for the frozen institutional credit market. In 2011, as the European debt crisis battered Bank of America, he wrote another $5 billion preferred check, this time at 6%, plus warrants to buy 700 million shares at $7.14. Those warrants ultimately became extraordinarily valuable. Now, the pattern across all of these deals was identical. Buffett deployed cash precisely when other potential buyers were frozen out. He extracted terms that would have been completely unavailable to him in a normal market. And he did it on businesses that were fundamentally good but temporarily desperate for liquidity. Now, scale that thinking up to $397 billion. That's enough to take controlling positions in major public companies and to fund private credit deals an order of magnitude larger than Mars Wrigley. It's enough to absorb forced selling across virtually any asset class on Earth. So, the question is not whether Berkshire Hathaway deploys this mountain of cash, but at what prices and under what conditions. And the deployment moment Buffett is preparing for is the exact same moment that historically defines the next cycle bottom across most risk assets. Which brings us to the third signal, the one that many commentators haven't fully acknowledged. Doing nothing is now itself a return. In a zero-rate environment, holding cash is a genuine drag. A $100 billion T-bill position in 2015 was earning essentially nothing, while equities compounded at double digits. The opportunity cost was brutal, and the only justification for holding cash at scale was conviction that something terrible was coming. The current environment, however, is very different. The Fed funds rate sits at 3.64%, 3-month T-bills are yielding 3.68%, and the entire short end of the curve is in the high threes. Berkshire's almost $400 billion treasury book is generating roughly $12 to $13 billion a year in interest income. That is more revenue than most S&P 500 companies produce in total. The opportunity cost calculation has fundamentally changed, and thus Buffett and Berkshire Hathaway don't need to be confident a crash is coming to justify their position. They just need to be bearish about forward returns on risk assets. The bar for holding cash has dropped, and this position reflects that structural shift. This is the most under-discussed reason for the build-up, and it tells you something important about how every long-duration capital allocator should be thinking about portfolio construction right now. So, we're no longer in an era where doing nothing is a costly drag on returns. What replaces it is a market environment where cash is optionality that earns a return, where the most disciplined investor in history is hoarding the stuff, and where the next major dislocation will define the coming decade of returns for whoever happens to have liquidity when it arrives. Buffett has been wrong about plenty of specific calls in his career. But what he has been consistently right about is reading the cycle. The two previous times he built cash positions of this magnitude, he was vindicated within 18 months by major market dislocations. This looks like being the third time. So, obviously, the takeaway is not to try and mirror Buffett's exact position, as most of us don't have the luxury of parking several figures in T-bills after all. But we should take the signal seriously. Position sizing matters more than usual when the most respected capital allocator in the world is signaling caution. Having cash on the sidelines means no longer carrying dead weight, but being prepared for what could be a generational opportunity. Buffett is preparing. Are you? But, well, what do you think? Is Buffett early, on time, or has he fluffed this call entirely? Feel free to get highly opinionated in the comments section down below. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.